Hi, I'm here today to talk to you about the cash flow cycle. And the reason at CFO on Call, while we're so interested in this phenomenon called the cash flow cycle, is that we hear a lot from small business owners that whilst their business is growing and they're making more sales, they're actually experiencing cash flow issues. And so the reason for those cash flow issues or cash flow squeeze is due to this phenomenon being the cash flow cycle. So I just want to explain that to you today, and hopefully I can get it across in plain English to you. So what happens typically in a business, before you can sell anything, you have to buy something. So if we're looking at a period of 1 through to 365 days, on day 1, you need to buy your stock, or if you're doing jobs or you're a service-based business, you would be buying materials. So what generally happens in a business is that the stock may sit around on the shelf for a while, and if you're a service-based business, a job may be in progress for a while. So let's say on average that your shelf life of your stock or the period that your jobs are in progress might be, say, 60 days. So that means on day 60 you would be selling your product or service, and if you're offering terms to your customers, you would be invoicing them. So that on day 60 you're doing your invoice. However, what happens between day 1 and day 60 is that you might only be getting, say, 30-day terms from your suppliers of this stock and materials. So on day 30 you have to pay your supplier. So what you've got at this point is 30 days negative cash flow. So you've got 30 days between day 30 and day 60 where you've had to pay your supplier. So the money's gone out to your supplier. Now, we put here the word invoice. So we're assuming that these customers are not paying cash on delivery. We're actually giving them terms to pay the invoice. And terms can vary from 7 days up to as much as 60 days. But what we all know in small business is that whilst you might put terms on your invoice or you might agree terms with customers, they don't always pay on time. So at the moment, the national average of time that customers take to pay is actually around about 60 days. So let's say that your customers are taking another 60 days to pay you. So on day 120, you get paid. So what you've got there is another 60 days of negative cash flow. So 60 days between day 60 and day 120 that your customer has taken to pay you. So if you add those two together, 30 days and 60 days, that's 90 days of negative cash flow. So 90 days the money is not in your bank account. It's with your supplier and it's with your customer. So the question is, where's the money going to come from to fund that sale? So if we've just demonstrated that to make a sale you need cash to fund that sale, it follows then that the more sales you make, the more cash you need. So unless you've organised borrowings or funding to fund the growth of your business, you've got to consider where this extra cash is going to come from. So apart from borrowing it, there are quite a few other things you can do to improve this situation. So what you want to do is to minimise this 90-day period. And the way you can do that is by extending the terms with your suppliers. So let's say you can try and go from 30 to 45 days. So you're reducing that from 30 days to 15 days. And you can also try and get paid more quickly by your customers. So try and maybe reduce that 60-day period to 30 days. So by reducing that number of days, that's obviously reducing the amount of cash that you need to fund the sales. And at CFO on Call, we've actually written a book on this subject, and it's called The 7 Key Numbers That Drive Profit and Cash Flow. So of those 7 key numbers, these two are 2 of the 7 key numbers. This one is accounts payable days, and this one is accounts receivable days. So this is the number of days you're taking to pay your suppliers, and this is the number of days you're taking to get paid by your customers. So in that book, there's some really simple day-to-day operational things that you can do to improve both of these numbers. So we're going to put up the information on the next slide for what you can do to download a free copy of that ebook. And as always, if you need help with financial management, all of our partners are ex-corporate financial controllers and CFOs. So they are very pragmatic in the way that they understand all of this, in the way that they're able to help our clients with understanding this and helping to find ways to improve the situation. So please feel free to call us and have a chat to one of our partners. We'll be more than happy to have a no obligation chat with you about any aspect of financial control. So I hope you found this helpful today, and please contact us for any help that you need.